Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thank you very much, Carolyn. Every month we look at new data so we can get a better idea of where the economy is headed and what that means for real estate markets. We mainly look at what's happening with jobs because more jobs mean more demand for housing. But this month, we again need to discuss the giant surge in home prices that affects every market in the country. The FHFA price index shows that the average home price in the third quarter was up 16% over last year. It's a huge amount. Here's what we're looking at. In the second quarter already, prices were up a lot, and the increase seems to be accelerating. I freely admit that I thought the pandemic would depress home prices, that greater financial insecurity would keep people both from buying and selling a home. During a recession, we've never seen home prices go up like this. Instead, we're seeing a surge like never before. For comparison, here's a picture of the last bubble in home prices just before the Great Recession of 2008. At that time, the price increase peaked at what now seems a modest 12%. And the sequel, which is why we should be very worried about the current surge, was that home prices then began a long downward slide of 15%. Going back to the current picture, one reason the average price is up so much is that prices are sharply higher in almost every local market in the country. Back then, 40% of local markets had a price increase of 10% or more. This time, it's 95% of all markets. Even in a market like Flint, Michigan, where unemployment is still 7%, where 12% of manufacturing jobs disappeared in the past year, where jobs are down 6% from the pre-pandemic level, and where the population has shrunk every year for the past decade, home prices were up 18%. Please explain that to me. The only possible explanation is that what we think we see isn't real. We normally rely on recent home price sales to tell us the value of all the other homes in the market. But there are times when that valuation market doesn't work, and a home price bubble is one of them. That's where we are right now. So yes, the prices of homes that recently sold in Flint are 18% higher than last year. That's real. But no, that doesn't mean the value of all homes in Flint is now 18% higher. It's an important difference because homeowners, lenders, and investors can all make wrong decisions when they misjudge real estate values. This price bubble isn't over. It can last another year. But my advice is that homeowners should not spend the extra equity they think they have in their home. Lenders should not make bushels of home equity loans, and investors should not rush to buy rental properties thinking they can just boost the rents. That's easy for me to say, but difficult for them to do. Meanwhile, the economy is doing better. Here's a picture of the total job situation compared to the level before the pandemic. We're just 0.5% from being back to even, and the acceleration in recent months indicates that improvement will continue throughout 2022. Jobs in business services are a main reason for the improvement. They're back to the level of positive growth they had before the pandemic, almost 3%. These are jobs that support other businesses, from accountants to cleaning services, so they're a very sensitive indicator of business activity. One of the important business services is companies that supply temporary workers, from receptionists to computer programmers. These jobs were a growing component of the workforce before the recession and are likely to be an even larger factor as more people do not want full-time jobs. Jobs in construction recovered early in the pandemic, but now apparently have maxed out. Much of this is due to the home price surge itself, which has prompted new home building. Like construction, the recent gain of jobs in finance is connected to the surge in home prices. This picture of jobs in retail is likely to continue in the future as more and more shopping is online. Note that Amazon warehouse workers, for the most part, are not included in these figures. Now we get into important sectors of the economy where further improvement will be slow. Manufacturing jobs are still creeping back up to zero. But even if more of these jobs eventually are brought back from overseas, that will take years. In the meantime, the pandemic has focused companies more and more on automation of their operations. The start of vaccinations earlier this year is clearly linked to the recovery of many jobs at restaurants. But the fact that this recovery has stalled suggests that many people still won't visit them and that many restaurant jobs are gone for good. It looks like governments, and that's mainly local governments, just won't have the financial resources to rehire the workers they had to let go because of budget constraints. They may in fact rely on more temporary workers, especially teachers, just as many colleges already do. That also may be the case in healthcare, where the job losses seem to be permanent. Although it's possible that hospitals and nursing homes, which are mainly for-profit operations, have found they can operate just as well with fewer staff. The pandemic has forced many businesses to take a close look at how many workers they actually need. That's it. The big question for real estate markets is how long the price bubble will last, how much damage will follow, and which local markets will be hurt the most. So let me plug our Investors Metro analysis, which shows how best to invest in this environment, how much risk you face in a local market, and the best rent range for investment in each local zip code. It's available for 200 markets and as easy to use as 123. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.